Hello and welcome. We're going to give it another 30 to 40 seconds as people trickle in and give them a bit of time. Good morning and hello. We're waiting for people to walk into the room. And good afternoon, good evening, wherever you happen to be. And we'll kick it off in another 10 to 15 seconds. People are continuing to come into this room. All right, welcome everyone to Cambridge Family Enterprise Group and to our quarterly webinar on the topic of preparation during times of turbulence, especially for family enterprises. We're glad you're here. My name is Dina Dvinov, and I'm the Director of Education and Operations at CFEG, and I'm your host for today. I'm delighted to introduce you to our speaker, Larry Pack, in just a few minutes, but first, some logistical information for the next hour. We invite you to ask questions throughout the webinar. Please use the Q&A function in the Zoom platform. We'll address your questions during the Q&A session at the end of the webinar. And our colleague Dan DeGuyer, the Education Portfolio Director, will join us and moderate the Q&A at the very end. You will receive a handout with some of the slides tomorrow in a follow-up email, and the webinar is being recorded and will be available on our website next week, so you can rewatch it and share it with others. If you experience any technology issues, please log out and then back in. Again, welcome. We're glad you're here. And Larry, over to you.
Thank you. And I would like to also personally extend my appreciation for everyone joining us today. First, just a very quick introduction about my background. I spent most of my career in research, banking, and portfolio management, mostly as a portfolio manager at a large hedge fund. For the past 10 years, I have been advising families on financial policies and strategies. This includes dividend policy, liquidity, capital allocation decisions, and even business analysis. I have extensive experience in direct investing and M&A, and along with Craig Cognetti, I co-lead the financial solutions practice at Cambridge Family Enterprise Group. So to briefly introduce CFEG, for those not familiar with us, we're a global organization specializing in family enterprises. We are 36 years old and have assisted more than 1,000 family enterprises worldwide. We specialize in helping family enterprises that are pursuing growth and multi-generational success, especially during changing times. And we do this primarily through our advisory services, education programs, and research. The topic of today's webinar largely comes out of our financial practice, where we assist owners with the issues that you see on the right side of the screen. We help family owners to be proactive about their wealth and growth, and to plan for not only what assets to own, but how to own them and who owns them, how to prepare the next generation to own them, and how to govern, monitor, and even change your assets over time. So let's move on to the conversation of the day, which is managing and creating value through uncertainty. And we're going to go through 4 sections, which is just discussing a little bit of today's turbulence, then going over some lessons from the last 7 economic crises. And then the meat of the takeaway today is going to be the 7 steps to prepare to create value in a downturn. So moving on, turbulence can come in many forms. Some are very definable and recognizable. Some are a bit harder to frame, but you can sense them percolating in the background. And I think we're all familiar with, the current trade war and the tariff uncertainty that has emerged in the past few months. It's challenging to know where things stand from day to day and even sometimes hour to hour. Many companies are still trying to figure it out. The implications can range from supply chain disruptions and the ability to source from foreign countries. Supply chains may be less reliable and material costs may be higher. Um, Companies may experience margin pressure due to the inability to predict the landed cost of a product and pass those higher costs on to customers. Um, from a financial market perspective, we've seen increased volatility, including an over 20% correction in the US stock markets at the lows this year. Um, in addition, the US dollar has been under constant pressure during this time, which is actually something one wouldn't have expected. Um, this is a lot to digest, and should certainly precipitate internal discussion and debate. Um, and I wanted to include in this quote from Jamie Dimon, the CEO of JP Morgan, a very revered executive. And this is something he said last month. The people who haven't been through a major downturn are missing the point about what can happen. Geopolitical risks are very, very, very high. Um, that's a lot of varies from the CEO of JP Morgan, which suggests to me we should probably pay attention. So I just want to get a little bit more granular on this. The market has actually seen M&A activity retreat back to COVID levels, which I would argue is actually one of the concrete signs of the uncertainty facing companies. And why is this? Well, when people are unsure of how to value assets, transactions don't get done. Buyers become more price sensitive. Sellers have to adjust price expectations to a new reality. And as we will discuss later, this discrepancy is actually at the heart of what leads to opportunities for during times of crisis. So, of course, tariffs and geopolitics are the obvious risks that we read about virtually every day, but they're not the only turbulent force impacting us. It's important that we don't forget about the risks that lurk in the background, but are increasingly a potential source of disruption to business, economic, and financial conditions. I'm not going to go through all of these, but let's take technology advances. Is anyone else surprised at the speed at which AI has been adopted and is seeping into everyday life? Frankly, this is the fastest technology adoption I can ever remember happening in my career. Last week, Andy Jassy, the CEO of Amazon, um, uh, said, as we roll out more generative AI and agents, it should change the way our work is done. We will need fewer people doing some of the jobs that are being done today and more people doing other types of jobs, end quote. Um, I can't think of any sector or industry that will be immune to this shift. And just to use one more example of broad turbulence, let's take demographics, which would fall under sort of socio-political and economic forces. Um, there's an increasing body of research on the declining populations of many OECD countries and the potential impacts to economies and societies at large. This isn't decades down the road. This is actually happening now. And when you put all this together, indeed, many experts say that this will be the most turbulent decade on record, potentially. Um, here, I want to just ask participants to take a quick poll. And this is mostly going to be relevant for participants that are active in a family enterprise or system in a decision-making or a deliberative role. And the question is really, where has recent turmoil, and we define recent as the past 6 months, been discussed in your family enterprise system? Is it in your family council, in your owner's council, boardroom, maybe your investment committee? Maybe it was just informally, or maybe you haven't discussed it at all. We'll give you a couple seconds to fill this in, and we'll give you the results.
Okay, I think we've got most of our answers. Couple more coming in. Last call. And here are the results.
Interesting. It's pretty broad. About half of you have discussed it in the boardroom, about 53%. Second is informally, 47%. Obviously, because there are multiple choices, this isn't going to add to 100%. 35% of you have been discussed it in the investment committee, and family council was 26%, and the owners council is 29%. I think this is great. This really shows that it's top of mind, and these are really relevant issues, and they're being elevated to the correct level. So moving on, let's talk about the nature of risks, and where do they come from. We're not just talking about the current environment in today's talk, but risk more broadly. Um, you know, in less turbulent periods, you could identify your main risks generally, and they were typically these. So for those of you involved in an operating company or direct investing, these are the primary risks that are usually top of mind: competitive positioning, customer market share, industry developments. But ask yourself, when you think about risks, do you consider the broader spectrum? Very often we'll find that it's the risks we haven't fully considered that are the ones we are ill-prepared to handle. And even when we identify them, the outlook can still be murky. This is why developing a process that will help not only guide your family and business through the turmoil, but also allow you to possibly find opportunities is really imperative. Without a preset decision-making system, this can all feel like chaos, and it can start to feel overwhelming, and the road ahead can seem foggy. So our chairman, John Davis, has talked extensively about this topic in the past, of environments and types of environments. Leaders and owners of family companies need to learn how to manage through periods of turbulence and even crises. So in times of relative steadiness, things still change. Industries mature, economies go up and down, albeit more gradually. And the highs and lows are generally not as severe. As the name suggests, there was more predictability in steady times. And operating in periods of relative steadiness can be challenging enough. It still requires innovation, an eye on financial stability, and some good directional decisions by owners and the family. But then, we get into turbulent times. Periods of turbulence are generally marked by unusually high levels of change and unpredictability, resulting in high and often even jerky economic and societal volatility, ups and downs. But then we move on to crises. Crises can generally be defined as non-regular, extreme negative events that create severe dislocations. The 2008 financial crisis was appropriately named. COVID was definitely a crisis. It accelerated to a point where it disrupted healthcare systems, business organizations, and entire economies. We all had to find new ways to operate and sustain. We provide this framework for you to think about as levels of escalation and events unfold. While we give discrete names for these levels of uncertainty, it's actually even better to think about them occurring on a spectrum. These events often evolve and generally aren't specific moments in time, but in hindsight, the evolution is recognizable. Even the financial crisis of 2008 can be traced back to events that started appearing in August of 2007. So think about that. It would be over a year before things really started to spiral. So making sense of crises. Crises often feel like chaos. As a crisis starts to unfold, there are some common characteristics that appear. Financial market chaos is often characterized by deep sell-offs in equities and a flight to safe assets. In business, you may see it in erratic behavior from customers and suppliers. Maybe customers start pulling back on business or asking for changes in payment terms. The information flow can be confusing, overwhelming, and even sometimes contradictory. In reality, what you are seeing is not irrational. It's often participants in the economy or in markets seeking liquidity wherever they can find it. It may manifest as cutting back on orders to preserve cash, for example, or asking for extended payment terms, maybe even backing out of deals. But the point is, behind the chaos, there are often rational decisions which can be tied back to liquidity. You're going to hear me mention this topic and this theme frequently throughout this talk. Um, it's also important to keep in mind when events unfold, they don't always actually impact every aspect of the economy. For example, the long-term capital management crisis of 1998 was a very important financial market event, caused a pretty big sell-off in the stock market, caused a little bit of a bump in the economy, but GDP actually kept growing throughout. Um, so the point is chaos and the reach for liquidity creates this unique combination of anxiety combined with opportunity. Preparation is the key to address both. Um, so before we move on, I want to provide one clarification and also one definition on two topics today or terms. You're going to hear me talk a lot about preparation. Why are we so focused on it? It's the prerequisite to creating value in uncertain times. The advanced work done regarding decision making reinforces a family owner's mindset and allows you to act when the time is right. Without preparation, it's easy for a family to lose sight of the big picture when crisis events transpire. Definitionally, I'm going to use the term investor today. I want to be clear that I'm not simply referring to someone engaged in financial markets, although that is part of it. When I say investor, I'm really referring to anyone within an organization that's an allocator of capital. So that could be a business owner, a board member, a chief investment officer. So for purposes of this presentation, people engaged in M&A and direct investing or really any capital allocation decision is considered an investor in the context of today. I just want to be clear that when you hear that term. So I want to talk a little bit about psychology and investor psychology. Um, the average investor during turbulent times exhibits certain traits. Um, Often there's an inability to see beyond the crisis or turmoil. The lack of preparation can sometimes lead to fears over liquidity, which could result in selling assets at depressed valuations, certainly something that's not ideal. There's often a deluge of information being received, some of which is useful and some of it is just noise. We find that the average investor has a difficult time telling the difference, or even more dangerous, extrapolating events based on emotion from reading too much of that information. And we sometimes see decisions being made without getting buy-in or alignment within the organization, which can create tensions and rifts that last even beyond the crisis. Contrast that with what long-term successful investors do. They approach the crisis dispassionately, evaluating the environment and the situation, and try to understand the possible impacts on the enterprise and the business. This doesn't mean having all of the answers. It simply means thinking in probabilities and analyzing without emotion, accepting facts as they are and not imparting personal feelings into the decision-making process. Secondly, successful investors understand how various scenarios may impact their enterprise and the family. Third, if you want to be an investor during turbulence, I said it before, having liquidity is a must. You will hear me repeat this again and again. Without liquidity, you materially constrain your options. Also, part of effective analysis is clarifying your objectives ahead of time. This way, everyone is pulling in the same direction and knowing what you're all trying to solve for together. Um, Also, with your objectives in mind and liquidity to act, the organization can then prepare a strategy and act confidently when the time is right. Um, this all falls under the headline of having an owner's or a value creation mindset. And I use those terms somewhat interchangeably. Investing during turbulent times is intellectually and emotionally challenging, and it can also feel terrible. But this is when your organization differentiates itself from the competition if you approach these events with the proper planning. So I just want to hone in on these terms that I mentioned just now: operator mindset and owner mindset. For long-term survival, you need both. An operator mindset focusing on operational excellence, and an owner mindset focusing on value creation, gaining altitude and fostering agility. Um, the operator mindset involves updating business models and practices and your mission, moving into new growth opportunities, and also culling investments and people that destroy value. Um, Basically, building greater resilience in your family and your company. An owner's mindset helps prepare you for turbulence and focus on value creation. And when you combine the operator mindset, focus on operational excellence with a value creation mindset, the combination leads to long-term survival. It's a combination that will really allow your organization to weather the inevitable storms it will face. So, if you consider today's environment to be turbulence, you may ask, is this unique? There's clearly a lot going on right now as it relates to industry and geopolitics. Um, the answer is it unique? Yes and no. Every bout of turbulence is unique in its own way, but there are also common threads that can be found in almost all times of uncertainty. So we're going to move on to the second block from today, which is lessons from the last seven economic crises, at least as I define them. So this is a brief look back at the last seven crises plus the current one, if we want to consider it a crisis. I conveniently picked this timeline because it spans my financial career, but obviously this can be extended back in time. Even just the descriptions of each event demonstrate that they were all unique. However, the interesting thing is they all had some similar effects and some similar traits. In every single one, capital flowed out of assets and economies deemed risky. Um, in short, there was a scramble for liquidity. Each one also had secondary effects. And eventually, every single one of these required government intervention of some sort. So when we feel like we're in a crisis episode that seems unprecedented, it may be, but remember that the behaviors and the patterns often repeat, which means it is possible to establish an effective playbook to deal with them. So I'm going to put you to work one last time. This is our second and last poll. And the question is, what current events are of high concern to your family enterprise system currently? And again, you can select all that apply. And I picked out what I think are sort of the obvious top of mind ones. So I apologize if something that concerns you is not covered in this. But the options are tariffs, government deficits, currency fluctuations, interest rate risk, military events, AI, or climate issues. So we'll take a second to let you fill that in.
The answers are nicely coming in. We'll give it another 10 seconds. And here are the results.
Amazing. Again, this is really, really spread out. The number one answer is tariffs. I guess that's not terribly surprising. But coming in tied for second, currency fluctuations and interest rate risk. Actually, in AI, all tied for three-way tie for second. And then not far behind are government deficits. And interestingly, military events second to last, and climate coming in last. It's a really interesting um, uh, list of answers because it also shows that we all have our own view as to what to worry about and where to be focused, which is actually great. Usually, if everyone's focused on one area, uh, oftentimes that can end up being sort of groupthink. But we can talk more about that if there are questions in the Q&A. So I wanted to include this quote from the famed investor Warren Buffett. These quotes, I'll just read them out loud. The first one is, "Cash combined with courage in a time of crisis is priceless." Um, and then, "Predicting rain doesn't count, building the ark does." Um, I love these quotes because they thoroughly capture the essence of this discussion. They highlight the importance of cash preparation and also the courage to act on your convictions. One of Buffett's recipes for success is finding companies that can weather any storm and buying them at good prices. Of course, that's simple to say and harder to do. But you may ask, why do I even want to invest in a turbulent environment? Um, it sounds risky and challenging, and frankly, it is. We spend most of our professional careers operating and allocating capital in relatively stable environments where, um, whether asset pricing, whether, M&A, direct investing, it's all generally more efficient. Price transparency is greater. The dispersion of possible outcomes seems narrower. Modeling expected returns requires fewer variables. In short, things are just more rational. You can actually invert everything I just said as it relates to turbulent environments. Obviously, there's greater risk. Price discovery becomes more opaque because it's harder to discern what assets are actually worth. The unknown unknowns expand, meaning possible outcomes are more varied and risks lurk in places we may not ordinarily worry about. Um, Liquidity is scarce and it leads to seemingly irrational decision making and inefficient pricing. This is when decision making gets emotionally and intellectually challenging, but this can also present some of the best opportunities if you're prepared. Just to give one example of a family I know, through their family office, they purchased some small and mid-sized banks during the financial crisis. For those of us old enough to remember what that time was like, it truly felt like the economy was crumbling and the financial sector was at the heart of it. Imagine the preparation, liquidity, and unity required to execute a purchase like that in the middle of the worst crisis since the Great Depression. Needless to say, the purchase was incredibly lucrative and looks genius in hindsight. But this was an organization that successfully integrated an operator mindset with the value creation mindset. So having the owner's mindset and value creation mindset means that we want to take advantage of the market inefficiencies to enhance or accelerate our objectives. To do this, it requires preparation of your liquidity. So we're gonna spend a little time on this. That means knowing what cash is available to you in a stressed environment, having identified your goals ahead of time, um, uh, understanding where you want to be in terms of if an event does happen. In the middle of the storm, it's not a great time to figure out which way you want to steer the boat. You need governance, how decision making will be made. That needs to be set ahead of time. You need to define your investment opportunities or which sandboxes you want to play in. Also, identify which signposts you will look for to determine when to make the decision. And lastly, you'll want to bring the next generation along, as these can be some of the best learning environments. The key message is to do the preparatory work when you're not under pressure. This way you approach difficult environments in a methodical way. So now we're going to get into the crux of the 7 steps to prepare to create value in a downturn. So we're going to get into the specifics in our playbook to prepare your family and organization. And let me just say, it's possible this may not come into play in the next few months or even the next year or two. But if you think back to the slide that included the timeline of crises, they occurred about once every 5 years. In a family enterprise, that can go by in a flash. So this will affect you at some point. So number one, sorry to have to beat this drum again, but it's so important. I've mentioned liquidity multiple times already. So hopefully you come away from this webinar appreciating that not only is liquidity important, but it's indispensable in times of crisis. You can't take advantage of the turbulence if you're spending your time trying to secure liquidity from a position of defense. If you enter the crisis with insufficient liquidity, well, that might be a discussion for another webinar. So in advance of any crisis, and actually as a matter of good practice, you should understand your liquidity profile. Stress test it. See what you may need in a downturn. Many, if not most of you, are in family systems. That means not only the business needs, but the family needs as well. What are the levers you can pull in a time of crisis? Basically, constantly evaluate if you are where you want to be with your liquidity position. This isn't just a practice for crises. This is a good practice generally. So continuing on liquidity, consider the types of liquidity: liquid assets, bank lines, cash cushions. Ask yourself, could you reduce dividends? What about in a time of crisis? What about owner's capital that may be available to support opportunities, meaning family members that personally contribute in a time of a crisis? Also, and this is very important, understand your bank credit and consider to what extent it will still be available to you in a time of crisis. For example, banks often change lending standards during these times. If your credit lines are dependent on certain asset coverage, make sure you have a view as to what that will look like if turbulence occurs. Again, why is this important? In order to take advantage of the turbulence, you need to have the liquidity in advance. Very simply, the people that make money in a crisis are the ones that can provide liquidity when others are seeking it. Cash is a very underrated risk management tool. Consider the case of a Brazilian family that's involved in real estate development during the economic downturn of 2008. Bank financing, which most real estate developers heavily rely on to finance projects, effectively evaporated. The Brazilian firm, however, had been expecting a downturn and had set aside cash reserves for many years instead of distributing larger dividends to the family owners. Rather than needing to borrow, like many of their competitors, the company had enough cash in hand to meet its obligations and even to make further acquisitions at favorable prices during the low points of the economic downturn. That's the family you want to be. Step two, now that we're comfortable knowing that we will have liquidity in a downturn, we can start evaluating opportunities. So evaluate and define your investment objectives. The information flow can sometimes feel like drinking from a fire hose when things start to get heated. So it's best to have defined parameters such as business goals that you're trying to achieve, financial returns you want to meet, strategic opportunities you're looking to get into, leverage you're willing to accept. And also, and very important, define your investment duration. Family businesses often have a unique advantage of long-term planning. Take advantage of that. Investing through turbulence often requires patience, and understand that when you make a capital allocation, it may not be the absolute low point of the crisis. Short-term thinking can get you into trouble. So at the very least, have an investment duration that is long enough to ride through the crisis. Make sure to match and also this is an important point, make sure to match the duration of your investment with the duration of your capital. What do I mean by that? Don't make a 7-year investment if you only have security of your capital that may be called away within 3 years. Um, if I could summarize the cause of the global financial crisis in a nutshell, that was it. Duration mismatch. That can happen at the company level too, without proper planning. So a demonstrated way to define your investment duration is to simultaneously plan and invest across multiple time horizons. I just wanted to briefly show this is a family CEO who we greatly admire. Adriana has an amazing way of looking at investing across multiple time horizons, and it has been very effective for her family enterprise. I love this quote, and I'll give you a couple seconds to read it. But I love especially the last part of it. It's quite fun to be able to play with all time horizons. Fun is an interesting word. It's the flexibility that a family can have in terms of duration is such a unique asset. So step three, uh, as I mentioned, we're going to talk about governance. As I mentioned, investing during a crisis is both emotionally and intellectually challenging. That's why having a decision-making process in place and agreed upon prior to entering a crisis is imperative. Good governance gives families a forum to discuss uncertainty, have vigorous debate, deliberate, and make decisions. Capital decisions become more disciplined because a framework is already established. With a good governance system in place, there's a clear direction and decisions can be streamlined, which allows for greater agility for the organization. You may not achieve unanimity, but you'll have a greater chance of achieving unity in the decisions, and the people involved will all feel they had a voice. And as always, good governance provides good oversight, not only of existing assets, but the future assets as well. All of this adds stability, especially during fragile times. Um, you may have some or all of these governance forums in place. They may work effectively during steady conditions, uh, uh, but they may be inadequate during turbulent times or crisis times. For example, they may end up being too slow, or you may find that you don't have the right expertise. So we recommend that you evaluate how effectively your governance will work, or how well you think it will work during turbulent periods, and adapt as needed. So one of the things that we want to suggest is consider, for example, adding a future readiness committee to your governance system. This may start as a temporary committee, but could become a standing committee. There's a lot to digest on this topic, but at a high level, basically determine what conditions would trigger its creation. Clearly identify the mandate of this committee. This isn't intended to take over typical functions of existing governing bodies, but you can define specifically what activities will they engage in, and it could range from simply monitoring events as they unfold, could be risk assessment, all the way up to recommendations on specific actions. Also consider who is best suited in your organization to serve on this committee. It may be an amalgam of family, board members, and management. It may not be an existing group that's already convened in your organization. CFEG will be talking a lot more about this topic in the future, and feel free to reach out if you'd like to discuss it in more detail. Moving on to step 4, and I mentioned this briefly before, but define your sandbox. Not only will information be voluminous during a crisis, you'll also know that the deal flow can sometimes increase dramatically, especially if word gets out that you have liquidity. Understanding ahead of time a set of criteria to which you will restrict yourself is really important. You're going to evaluate a bevy of deals, and an easy way to whittle down the opportunities is to understand your family's goals and values. Are we looking for diversification or complementary businesses? Does this opportunity fit within our family values, or is it an area where we've decided not to participate? By default, you'll find this also allows you to create no-go areas, essentially limitations, geographic limitations, or business criteria, maybe financial metrics. We included this slide to give a more graphical way of thinking about defining your sandbox. I want you to see as we go down, each bar represents criteria to consider and where you feel you want to be on the continuum should opportunities arise. Indeed, this slide doesn't even necessarily just apply to moments of crisis, but can be a tool for consistent evaluation. But just consider some of the topics on here. At the bottom, what's your risk appetite? Conservative or aggressive? Your investment timeline, long-term, shorter term. It gives you a lot to sort of think about in terms of framing a discussion within your family. So if you've worked with CFEG in the past or been to our seminars, you'll have heard us talk about this. Build value according to your values. This is a tenet we believe strongly in at our firm. Knowing your values and building value according to your family's values is vital to defining the right sandbox for your family and finding the right investment opportunities. This extends to crises as well as beyond crises. So step 5. So when crises arise, you may want to increase the deal flow coming to your family enterprise. We did talk in step 4 that we've already defined our sandbox, and it can be very useful to actually reach out to bankers, commercial lenders, business contacts, financial advisors, corporate attorneys. Let them know that you want to see deal flow. You can also relay to them whether you're looking for M&A, direct investments, financial investments, etc. This may result in quite a voluminous number of incoming calls because many of these service providers will start looking at you as a problem solver. They are generally looking to solve problems for other clients that aren't prepared and that have liquidity issues. You having ample liquidity will be seen as a possible answer to their clients' problems. Oops, here we go. So also you'll want to look at for your corporate diversification portfolio or your corporate portfolio diversification, or whether you want unrelated diversification, organic growth. These are all things that you would relay to people that are showing in deals to your firm. So timing your investment decision is an important topic. I would really want to steer you away from thinking about trying to predict the depth of the turmoil, when it may end and how it may end. Rather, make the decision relative to your internal criteria, such as valuation. Maybe we're waiting for the assets to get to certain price levels, acquiring talent through an investment. Maybe we want to enhance our team by making an acquisition that wasn't previously available. Maybe we want to fill in technology gaps. I could go on, but try to eliminate the notion that you're going to time the bottom. You'll spend more effort focusing on something you can control and are liable to miss the big opportunity. The notion of not timing the bottom gets to a typical trait in investor psychology, which is we tend to straight line events, and it's rarely the right way to look at things. We basically extrapolate the turmoil into infinity. And I'm going to use a financial chart here simply because there is a lot of data and it's easier to see the visual. This is the S&P 500 from February to early April this year. And this was the action of the market with obviously a lot of concerns around tariffs. I can't tell you how many emails I was receiving at the beginning of April saying that the market was going to keep going down and a litany of reasons why. Frankly, I didn't have a view either way, and that's actually besides the point. but it felt like a pile-on because everyone saw the trend. People that took that advice would have missed a huge rally. They would have sold the market down 20% and missed a 2-month recovery that is approaching new highs. This is a recent example, but I just want to highlight that because I saw similar behavior, for example, in the financial crisis. By March of 2009, businesses and investors were resigned to that things were never going to get better. Of course, they would have missed one of the great recoveries in recent decades. So my point is to not get too cute in trying to time your decisions. If assets meet predefined criteria, act, have confidence in the work that you and your organization have done. And let's walk through what this may look like. So assume you've identified an asset you'd like to acquire and a crisis starts to percolate. We'll know this because our Future Readiness Committee has convened and told us we need to be on alert. So the committee has met and we now have set parameters and we know that where we want to start considering buying these assets. This is represented by the dotted horizontal line. The asset gets to our price and we act, but the crisis deepens. Do we panic? No, because when we set our price, we built in some cushion into our valuation and we're okay to ride this out. Over time, the environment reverts back to stability, and the blue triangle area on the right is all the value that we created. So lastly, while steps 1 through 6 can be done successfully with the now gen and the acting board and council members, as family enterprises, we should generally be looking for opportunities to include and elevate the next generation. Turbulence and crises are some of the best learning opportunities they will have. Including them as board observers or committee observers really introduces them in a real world setting to what an owner's mindset is. And it will instill in them the values and the culture of how your family operates together. You'll teach them how to be stewards of the family capital according to your values. And just going even deeper into that, invite them to participate in the due diligence process. Maybe include them in the vetting process as well as you're looking at deals. If they aren't familiar with the family's investment policy statement or investment criteria generally, this is a great way to introduce them. You'll find it increases engagement, fosters unity because it's like you're all in the trenches together at this crucial and stressful time. So that's our downturn preparation playbook for family enterprises. Hopefully the concepts resonate with you, prompt some discussion within your organization as to your readiness to deal with changes on the spectrum from stability to crisis. I certainly don't want to suggest that this is easy stuff, but good preparation can really give your organization a chance to create value out of turmoil.
Thank you, Larry, for your presentation. And hello, everyone. As Dina shared, my name is Dan DeGoyer, and I'm CFEG's Education Portfolio Director. And I'll moderate the Q&A discussion. Just a reminder, a handout with some of the slides will be shared along with the recording. So there were some questions about that in the chat. So Larry, to begin, referring to the 2 polls that highlighted today's turbulence in our lives, in this context, what current events should be most concerning to family enterprises from your perspective as an expert?
When I think about what would concern me the most, as families, we like to think long-term, and we like to encourage our families to think long-term. The things that are in my mind right now that I'm watching closely are currencies and interest rates, and I believe we saw that in the polls. And the reason that is crucial now is because, and this gets into a little bit of an economic discussion, but we can see that from signals in the dollar and concerns about budget deficits, that there is some interest rate risk. And there's also we're even seeing it here at CFEG, some families that maybe want to have a little bit less money in the US, or they want to have more money in other regions. What this all ties to is the idea that maybe the dollar is going to be in a continuingly weakening trend, which also would mean that maybe interest rates are going to have stay higher for longer. We certainly haven't seen that yet, but we've seen some risks of that this year, as for those of you who follow, for example, the 10-year yield as an indicator. I'm not trying to get too wonky with the financial analysis, but this is actually very important, that if interest rates and the currency become untethered, that has very big implications for operations, for family businesses, for pretty much everybody.
Thank you. Next question. This is in the context of the investor psychology and the owner mindset. And you mentioned that one of the skills needed is to distinguish between noise and information. So in terms of being able to do that as a successful long-term investor, what's the best way to do that?
What I like to recommend, and what I actually do personally, is for the topics that are of concern to me. So if we take some of those topics that were on there, climate and AI and interest rates, take some time to find the people that you find are experts, where you know ahead of time that these are people that are serious. They do serious analysis. They're not the ones that are just throwing things on Twitter or X or social media, that people that have really provide insights and unique thoughts. And it doesn't mean that these people have to be right, but they prompt thought within you and within your organization. If you know that these are the people that you ahead of time that are serious about the way they approach some of these topics, when a crisis comes, again, the information flow really starts to come in dramatically. And you want to sort of be able to know ahead of time who are the people that you really want to listen to, so you can drown out the other data points, which may not be coming from any point of expertise or real insight, and they could just be people speculating on what's happening.
Thanks. We have time for 2 more questions. The first one is in regard to the governance practices in step 3, adapt your governance. What stands out to you about creating a future readiness committee that will be particularly useful during uncertainty, such as board independence, family council? What should be in place there?
Yeah, so the Future Readiness Committee, the reason this is such an interesting topic is because the people that are best suited to help navigate through tumultuous times within an organization may not necessarily be the same people that are all sitting on a board, or all sitting on a family council, or all within management. It may be certain people within each one of those bodies or other bodies that have particular expertise of how to navigate this. And that's why having this committee, which again, it may be a standing committee, it may not be a standing committee, but having those people that you're going to call on, that are going to meet to discuss events as they unfold, is really important. These are going to be people that maybe have had experience going through this, bring certain unique traits and characteristics. They're not everybody in every board and every committee is going to be the right person to help navigate through tumultuous times. They require crises that require a unique mindset, and that also could be unique capabilities within the different committees.
Thank you. So for the last question then, we know that economic crises come and go. What do you observe about the current turbulent environment that gives you a sense of optimism or confidence the families who prepare themselves will prevail and thrive?
Yeah, I mean, look, the current environment. It's really only been 4 or 5 months that the uncertainty has really kind of set in, um, and we still haven't seen interest rates come unglued. We're still seeing GDP grow. Um, there's optimism there. Uh, the concerns are also things like AI, but at the same time, AI, you could put a positive spin on that, saying AI is going to be a huge productivity boost to the economy at a time when workers may be becoming more scarce. So there's definitely, I'm not sitting here, being able to pinpoint where I think there's a systemic risk in the entire system right now. Doesn't mean it can't happen. Um, but frankly, I mean, I think that there's a lot to be optimistic about. Doesn't mean we shouldn't be preparing. I'm preparing. We're advising our families to prepare just to be ready in case something happens. But right now, I mean, look, we've made it through a pretty difficult period, and um, the sky hasn't fallen. Companies are sort of figuring out how to manage through this, and it just goes to the ingenuity of the managements and the families and the businesses that we see out there.
Thank you, Larry. Back to you to wrap up.
Okay. So upcoming family enterprise education. We just want to highlight a few things that we have upcoming with Cambridge. First of all, continuing on today's topic, Professor John Davis, our chairman, will deliver a webinar at MIT on July 9th on how owners can lead their family enterprises during turbulent times. Great continuation from the discussion we've had today. Our program about how to design your family's total wealth strategy is a live online 4-day program that we offer next in May of 2026. So think about that one. And then for those interested in an intensive learning experience, John Davis's 6-day program at MIT is for multi-generational family teams to learn an action plan about family enterprise success in changing times. The next program for that one is October 2025. And we do offer that every 6 months on the MIT campus. And lastly, we would encourage you to subscribe to our newsletter if you're interested in our quarterly resources and conversations about family enterprise generally. And we look forward to staying in touch. Really appreciate everybody who participated today. Please reach out if you have any questions or want to continue any of these discussions. And this is a really important topic, and we really hope that everybody comes away from this with an understanding of at least how to help prepare their organization. So thank you very much.